So George, you've got a lot of experience in the fixed income and structured product space. How do you see these to be product areas that are big opportunities for exchanges to leverage and to diversify into or to grow?
Well, obviously they are very big opportunities. The markets on the OTC side are significantly larger than the exchange volume. For the structured derivatives, for example, the estimate in both Switzerland and Germany is about 30% of the volume is traded on exchange, and something like 70% is traded in the OTC market. So it's a very big potential. Obviously, fixed income OTC market is an order of scale, magnitude greater than that in relation to that that's traded on exchange. So in a way, it's a little bit like Coca-Cola when they realized in the 90s that their competition was water. And I think it's a little bit like that. There's an enormous amount of potential for exchanges to expand.
And how can the exchanges get back some of this OTC volume? What is their value proposition?
Well, that's always a little bit tricky. I think exchanges typically tend to focus on the standard things like transparency and regulation. But there's a great deal of other advantages an exchange offers. One is being a central party where the buy side can trade against each other. For example, if you're a trading fund or pension fund in Scandinavia and you want to buy a particular bond, and somebody else wants to sell based in Lugano, then the chances are you'll never hear about each other. So effectively, you've got a very diverse set of interests. But exchanges have a lot of other advantages. They can offer things like standardization. Mm-hmm. For example, we see a lot of our customers, for them, straight through processing, just getting the whole trade flow working is extremely important. And often they have problems with static data. Something like 90% of failures that happen are due to static data. And exchanges, for example, can monetize that and can provide standardized information, static data, and sell that out, and that can be used to sufficiently improve that whole trade flow, which is very important for our customers to get an electronic, smooth trade flowing at it.
So does that mean the exchanges could sell components of the service rather than the soup to nuts service? I.e., they don't necessarily have to sell the matching services. They could sell the, as you say, the static data provision, or is it an all or nothing type
Yes,
thing?
no, absolutely. I think there's every market has its own particular characteristics. The fixed income market very traditionally doesn't charge trading fees. There's no, if you talk to a bond trader about ticket fees, they look at you like you come from Mars. And but they do have a value in improving their trading process, in finding liquidity, and again a better execution. So I think there are business models around that, either selling market data, selling static data, that you can be a little bit intuitive with and find something slightly different than the typical equity model.
Tell us a bit about some of the initiatives you're involved in at the moment, because I think you're developing some new product areas with some exchanges.
Yes, I mean, obviously, as a technology provider, we connect to a rather large range of liquidity pools. So we see a number of initiatives. One initiative we're connecting to at the moment is the Luxembourg Stock Exchange. They're bringing a new fund trading segment with 6,500 funds on it. And we've done the quoting piece for one of our customers, the Credit Bank in Luxembourg, and they'll be one of the primary market makers on that segment. Also, Scotch, for example, they have a new segment they're bringing in at the end of the year together with a partner for derivative partners, which is a non-regulated or less regulated segment. I think that's a very interesting proposition. What they're doing is they're bringing in effectively a parallel segment with a slightly different model for the OTC derivatives.
Is that Scotch Switzerland or Scotch?
That's Scotch Switzerland, yes.
Right.
Yes.
So it's effectively half OTC or something, is it?
Exactly. They're bringing in a model where effectively they're saying, okay, we don't want to apply the full exchange model for a wide range of products, so we bring in a model together with derivative partners as a lighter regulation, but bringing in some of the advantages that an exchange nevertheless has.
So will that become exchange traded and exchange reported, or?
Well,
is it just reported?
You should ask Christian Katz, I suppose, for more details. My belief is that they're coming in at the end of the year. My belief is that it's primarily focusing around reporting and the post-trade transparency. But I think Christian probably could give you a bit more information about that. And another markets that we're seeing, of course, is the bond markets. I think there's an enormous amount of change to happen there. We're connecting to Bond Match, which is an MTF from NYSE. And also, of course, on the OTC markets, we've been connecting to Bloomberg, just trying to get our customers have a much more electronic trading flow for the OTC markets as well.
Right. Picking up on the bond match idea, that was a buy-side driven initiative initially, where the buy-side wanted change, etc. The French government were behind it, trying to basically repatriate their market to France, but it's actually not achieved too much. It's essentially a lit market, retail volumes, I think only one buy-side member. So what went wrong there?
Well, I don't think they did the right model. I think they went very much for an equity market model.
Yeah.
I think there's going to be an enormous amount of change in the bond market going forward. The bond market, for me, is a broken market.
Yeah.
It's fundamentally a market which doesn't work properly. And people have made a number of attempts in the past to solve that problem. It's a difficult problem to solve. It has slightly different trading requirements than equity markets. But I think there's going to be a lot of attempts. Vega Chai, I think, is a good attempt that they're doing there. And I'm sure other people are going to come up. And I think as a technology provider, we can provide a lot of value for our customers in basically providing connectivity to these different solutions and effectively being part of that process going forward.
So, and in the bond space, if the lit solution is not the solution to resolve the OTC volumes being still over the counter, and a dealer-driven solution, is that still going to be the solution, or what else do you see on the cards?
Well, I think a hybrid will be there. I'm sure dealers will have a very important role to play. I don't think that's going to go away. But I do think there is a frustration amongst the buy side that if they do have a product they want to place and the liquidity isn't there, and the dealer effectively has much wider spreads these days than they did a couple of years ago, often there is maybe another counterparty somewhere around the globe. There may be somebody in Singapore that wants to sell the bond that you want to buy. And I think it'll go in the direction of non-lit books, that finding effectively trying to do some price discovery, maybe a hybrid where that if you don't find a counterparty, that the dealer picks up the trade, which probably will still happen in a large percentage of the dealers. I mean, obviously, liquidity is very diverse in the bond market, so I don't think the dealer is going to go away from that market. But I just think that particularly at certain times when liquidity dries up, the buy side would like to have the ability to trade against each other, but not with full price transparency.
But I mean, if we look at Patrick's slides from the first session, he was saying that essentially in the fixed income market, that return on equity is moving from 18% to about 7% before mitigation actions, and then around about 11%, which is around about the cost of capital. So that would force dealers to essentially get rid of inventory. So then what is their added value in this post-Basel 2.5 and MiFID II world? I mean, if they haven't got the inventory, then...
Well, exactly. I think we're seeing already spreads have widened significantly. Some of the players have gone out of the market. I think there'll be some consolidation on there. Not everyone will want to put their liquidity into the market. But I think there still will be people prepared to put liquidity into the market. Maybe they'll charge a little bit more for that service. But I do think that is going to be a model which is a little bit more specialized. It won't be not all trading will go that way anymore. UBS PIN, for example, is also a very interesting attempt to have a bit of a hybrid there, where they can allow the buy side to trade against each other, but they can also pick off the volume. So I think it's some kind of hybrid will be the solution.
Okay. If Carlo can come up, but I'll just carry on that point. So UBS PIN, what that is, you say it allows buy side to buy side or buy side against UBS. Where do you see that going with the MiFID II regulation? Do you think that will end up having to become an MTF or an OTF?
Absolutely, yes. I think there's no question about that.
And then what would be the role of prop trading in that model? Would it be able to interact with that, or would it not be allowed anymore? So where does that leave UBS?
I mean, obviously that consultation is running, and that's something that UBS, I'm sure, will be following very closely. Personally, I think a hybrid will be something that's needed for the bond market, so it'll be a very big shame if they're not allowed to interact with that flow. But I think there will be certain rules around how they compartmentalize the different departments and what they're allowed to show to their prop traders. So I think that'll become much more stringent, but I think it'd be a shame if you're not allowed to interact with it.
So it would have to be non-discriminatory and systematic, so they'd be just treated like any other party in the pool, I guess.
I assume that will be the case, yes.
Okay. So Carlo, welcome. The Luxembourg Stock Exchange, you've already been plugged. Traditionally, it's been a very successful venue for the listing of fixed income securities and funds. What is the future direction that you're planning to take?
Yeah, thank you, Brian. Well, in fact, as you correctly say, the Luxembourg Stock Exchange today is a listing center mainly for international securities. We are a very small exchange in a very small country, but we do have today 3,000 issuers who have listed 45,000 different securities. The issuers come from 105 different countries, so we are very international. But right from the beginning, the business model of the Luxembourg Stock Exchange was, as you mentioned, to offer listing services. Our market and the members was too small to have a large liquidity on those securities. So right from the beginning, the trades have always been done OTC, mainly OTC. I'm not saying that there is no trading activity, but it is quite low. Yeah, I don't think that the OTC is an enemy of the exchanges in all the cases. Especially in our case, I think it is a model which exists, which is accepted by the players of the international capital market. So today, the investment banks and the issuers and the investors, they are quite happy with this model that you have an exchange listing all these securities, and that the trades are mainly done OTC. So for us, OTC is not really an enemy. Both coexist, and I think one needs the other.
But picking on what George was saying earlier about the changes going on in the fixed income space, you have the monopoly almost on fixed income listing. Are you doing anything to get into the fixed income secondary market?
Well, sure. Of course, we would like to have more trades also on exchange. So we try to attract also the trades. But it is difficult. What we have done, as you know, we have this partnership with Euronext in place, which means that we use their trading platform, the UTP, and we also have more and more cross-members of the Euronext exchanges, which can access our market, our securities, and there is an increase in the trading activity due to the activity coming from these cross-members, actually. So that is one thing. What we also have done is we have put in place also in 2008 a CCP with LCH ClearNet, which is also quite successful, especially on the bond side. So we do see more trades coming on the bond side. It's a slow process, but it's going in the good direction.
Is that LCH and ClearNet, or just ClearNet, given the French side of it?
It's really LCH ClearNet.
So it's both, because they're not interoperable?
No. Okay. And we have today about 800 securities where the settlement is organized via CCP, LCH ClearNet.
And is that helping to improve on-exchange liquidity?
That's definitely helping to increase trades. It is extremely difficult to put these systems in place, but it's a hard process. But we see that the number of trades is going up. In addition to that, we have also now members of the exchange who are acting as market makers for about 1,000 bonds today, which also helps us to have more liquidity in these securities.
You've got a big buy-side community locally. How are you leveraging that into the exchange? Or do you just rely totally on the dealer community, the market makers, etc.?
Well, I think for the bond side, it's quite difficult. There will be other initiatives like what George has mentioned. Luxembourg today has a very strong investment fund community. We have Luxembourg is very active in the fund administration. A lot of funds are domiciled in Luxembourg. And so one opportunity which we have seen is indeed to try to have also secondary market trading for these investment funds on exchange. And we have already seen the first trades being done now recently in the last weeks and months.
Okay. Michael, if you can come up, please. And while Michael Buhl, who's the CEO of the Vienna Stock Exchange, is coming up, one final question, Carlo. In the context of new regulatory changes in the sort of data reporting space, etc., what is Luxembourg doing to try and capitalize on that opportunity and recapture some of the OTC space?
Well, I think the Luxembourg Stock Exchange will definitely try to play a role in the data reporting area. That's something where we are already active today. We have a system in place which is called e-file, which can be used for various purposes. So reporting to authorities, etc. And we think that this system could also be used in the future to fulfill certain requirements which come from the new MiFID, MiFIR, and also the EMIR regulation. And then it is clear that we also try to develop the data vending, which exists already today, but we have put in place also a financial news service to publish and also push regulated information throughout Europe. We have also, the Luxembourg Stock Exchange has also been designated as officially appointed mechanism under transparency law, so these kind of activities will hopefully diversify our revenues.
Okay. Michael, in the OTC space, I mean, for example, we take the products we've talked about, the fixed income, 85% OTC, the funds, similar or more percentage. And the equities, pan-European, 40%. What that kind of indicates is that you know, we've lost some of the sight on where exchanges should be and whether politicians really understand the value of exchanges in terms of the capital formation, etc. Where is Vienna positioned in this whole argument? Do you have huge OTC volumes, or do you have more on-exchange trading? And do the politicians support the growth of your economy through the exchange?
Well, to start with, in general, do we have a large OTC market? But obviously, the Vienna Stock Exchange is very much focused not so much on listing, but rather on trading. I rather have some listings which actually are tradable afterwards, and so our focus is definitely on the equity side. And I think there you simply have the question is, are you a bigger exchange or a smaller exchange? In general, MiFID brought about, and we all know that, brought about higher fragmentations of the market, and therefore there's lots of trading today in various venues, also of course in OTC. There has been OTC before MiFID, but it has been increased actually by MiFID because it has been broken up actually all the venues and the possibilities where to trade, how to trade and everything. So in general it was something which was increasing, and at the beginning I thought it is something which is mainly about the big markets, and the smaller ones will follow because of obviously MTFs were first of all focusing on a bigger stocks, on more liquid stocks, and then actually fostering down into the smaller markets as well. But actually I had to realize that unfortunately the small exchanges were hit not so much maybe by the MTFs in the beginning. Today, yes, as well, a little bit less than the big exchanges, but I would say that as of today, it's been building up over time, and we're currently about around 20 to 25% of Austrian stocks are actually traded on MTFs. The OTC space in the past has been around 70%, 75% on exchange, 20-25% off exchange, and this has stayed more or less the same. So in this respect, that's what we see. But you also have been asking about the political side, and unfortunately, their Austrian politicians are totally, I would say, disastrously agnostic to the stock exchange currently. They do know we exist, but that's about it. I have personally feeling most of them, all of them at least in a governmental position, like ministries and especially our prime minister, they don't have a clue what we're doing. They're not interested in what we're doing as long as we don't run the whole economy down. And this is, of course, we are seen in the vicinities of those bad bankers which have been actually, you know, doing whatever they did, and of course receiving those big checks where actually we do have, of course, the prime minister being not happy with that because these people are earning more than me.
So the message is that essentially you're just yet another company that is trying to make a profit, and there's no national economic development role. So in that space, in terms of trying to either diversify or recover volume that is in the OTC space, what level of volume in the equity business that is done in the OTC area has no market impact? So i.e. it should be on exchange and subject to price discovery, but is trading away from the market basically to save market information for the members, or alternatively save costs, your transaction fees. But in fact it could be traded on you with no market impact.
Well, in general, I think actually all. I'm very much not of the opinion, as Carlo said, the two belong together and therefore they're married and they have a happy time together. I don't think so, because what we do see on the equity side is a growing discomfort also with our companies with the splitting of their liquidity and volumes over various venues. And of course OTC, as the least regulated, least transparent part, is the main concern for them, because what happens is the more we see trading on the OTC space, the less is obviously then, because usually it is not really that OTC business then coming to the market to digest, but it's actually really going off into the opaque area. And what we do have then is companies, especially if we're talking about smaller companies, like the ones which are listed on the Vienna Stock Exchange, are in European comparison maximum mid-size, small to mid-size. Now what happens is, if there's more trading on the OTC side, it looks like the liquidity on the exchange is even worse than it is. And therefore, they find it difficult to talk to investors and tell investors that they are still a liquid stock, and it makes sense actually to invest in them. And if you go to the US and you know that some even of the small cap funds do not touch anything which is less than a $5 million US dollar ticket size, this becomes a topic. So it is something where I think we do have a problem. Therefore, we also see that we have this splitting of the market which does not offer access to small clients, mainly private clients, because they do not have access to MTFs. They do not have access normally to the OTC space. They only have the exchange. And what happens if there's less liquidity in the exchange, spreads widen, and the private investors actually have definitely worse prices. So it is something which I think we should much more focus also on a regulatory basis, if you want so. I mean, I'm not calling for the investors, calling for the regulators normally, but in this case, we do need to commit to that MiFID I was actually a failure. I think, meanwhile, there have been these two main aims of MiFID I. The one was more competition, yes, done, but the second one was higher transparency, and this is a total failed. And if you take the whole thing then together, and we're looking now into MiFID II, and they want to have an OTF, and I mean, it's wishful thinking to say that OTC is then going to move up to OTF. What happens, and I'm pretty sure that this is going to happen, is that the more regulated business is going to come down from the regulated markets and the MTFs into the OTF, and not the OTC will move up to a higher regulated. That's just natural. It's life is that way. You tend to do the least necessary. So and we also cannot say we'll solve the whole thing then with consolidated data tape. I mean, that's interesting, isn't it? Because we say we want to have competition everywhere, but then we say, let's have a monopoly on consolidated data. Fantastic. I mean, it's totally against the normal thinking of the European Union. But this is how they try to solve the problem and actually the failure which they created in the first place. So it does, but there's still a big difference, because on the OTC side, the problem which we have is that there might be some reporting later on, but the deal is done. There is definitely information asymmetries in the market. There are some people who do have access to that information, some people do not have access. Definitely, there will be no access to that information before the deal is done. So what does belong to the exchanges, I think, if possible, on equity trading side, everything. But of course, if you say there might be some ways and some deals, transactions which should have a right to be done on the OTC side, it would be professional trade on an irregular, ad hoc, on a from time to time basis, and I would say only if executed against the own account of the investment firm.
Yeah, I agree. So what can you do? Okay, we're calling for regulation to try and improve this. Hopefully MiFID II won't be diluted.
I don't think so. If you call for regulators, you're lost.
Exactly. So what are the mitigating actions you can do to recover some of this volume?
We're trying to do the best with regard to doing best service for our issuers and go out, take the issuers actually as also with some presence of the exchange to investors, try to do the best service possible on all sides with all our stakeholders, and try to convince them that still the best focus of liquidity is actually at the exchange.
Do you do anything on execution quality? So do you compare OTC executions with the quality of executions on your market and then try and stir things up if they're not getting the best X?
It's almost impossible to, I do not get hold of information how execution quality has been. Sometimes somebody tries, I get complaints sometimes about executions and which turns out to be OTC because actually they think it should have been on the exchange anyhow, but this is then rather seldom.
But then where are they reporting this? Where if they...
the OTC business is reported directly to the supervisory authority.
Oh, okay. So you
and officially, I don't get any information about it. Sometimes you get it unofficially, but let's put it there.
So maybe there's something that needs to be done equally there on the regulatory side to get so that you can compete on execution quality.
Yeah, but if I make one more sense also with regard to the supervisory authorities. The problem which I don't know how it is with other exchanges, but what we're facing from time to time, meanwhile, is that the supervisory authority steps in investigating if once a big deal is done. And my market participants today, from pretty often, meanwhile, tell me we try to not execute on the exchange anymore, because if let's say this is a big ticket now, if I execute 50,000 something on the exchange, I will have the supervisory authority call me tomorrow in the morning, ask me why we had this big actually market moving order, and my trader will have to spend about half a day on explaining and reporting instead of trading. So it's much better for me, and today with MiFID it is possible to do it, internalize, MTF, OTC, whatever. Just try to not get actually into the focus of the supervisory authorities.
Interesting. So in this OTC space, how important is it to be involved in the primary market first in order for an exchange to then get the follow-on secondary activity, George? I think that's relevant in the structured products in particular.
Yes, I think providing a total solution and a total destination is very important. So I think it is important for an exchange to be in the primary market. But by primary market, I mean the issuance of the product. Now, I don't think that needs to be the case. I think it's. I think there's I think there's no requirement for the. I think the exchange should try and provide a total solution and provide as many different asset classes as possible, as we heard earlier in the panel. But I don't think the issuance of the product needs to be done via the exchange.
So some of these structured products, they can still be issued but on an OTC basis?
Yes, yes. No, I think, again, you need to base it on the different segments you're involved in. I think equity markets are very often they're not directly involved in the primary market. But I think with the structured products, typically exchanges are concentrating very much on the secondary trading.
Are there any questions from the audience? Come on, there must be. Can't be that uninteresting. Like, the gentleman from UBS.
Well, thank you for interesting discussion. I'm Simi from UBS. Just one question for the listing for the fund or structured product or fixed income product. How do you manage the quality of listed product on your exchange venues? Well, obviously, I think you may set the listing standard or disclosure standard or governance standard, but maybe different from the equity issuers. So I just want to know the...
Carlo?
Investment funds,
yeah. How do you manage the quality of the listings for the...
Yeah, well, as you say, I think the investment funds, which are the UCITS funds, typically located in Luxembourg, they are governed by the UCITS law already. So there are very stringent requirements already for the launch of an investment fund and also for the ongoing disclosure requirements. That is something that is out of scope of the exchanges, I would say. Of course, these investment funds have certain reporting obligations to the exchange also, which will allow us to monitor and to adjust the relevant data in our database. But the general legal obligations, the disclosure obligations, are not in the scope of the stock exchange.
So what's the value added of listing?
Yeah, the value. Well, first, generally the idea to list investment funds. Well, a lot of we do have today about 7,000 investment funds listed in Luxembourg, mainly Luxembourg-based UCITS funds. The reason for this is mainly for the marketing of the funds. Well, the marketing is easier if the selling of the funds is easier if they are listed on exchange. That's at least the experience in Luxembourg.
Does that mean the exchange does any due diligence on the listing process?
Well, for investment funds, it's a bit different compared to other securities, I would say, because when you launch a fund, there's the fund law, which is applicable generally, and the whole disclosure, etc., the requirements, they are checked by the CSSF, so the regulatory authority. And so there is not much due diligence done by exchanges in this particular case of investment funds. Well, then for the trading, in addition to initial listing, I think the reason which was behind this particular case now, when we have launched this initiative, was really to have also more transparency towards investors. I think that was really the main driver for this initiative.
Michael, what's your view on this?
Sorry, what?
On the question from UBS.
On investment funds, well, we did have actually a couple of investment funds. So this one is better. We did have a couple of investment funds listed some time ago, and we again then delisted it as there was not really an interest so much on exchange traded side. There was almost no liquidity, and we didn't actually want to actually burden the system. We, as I said earlier, we do not really believe in having listings which are kind of dead and there's no trading in it, because it doesn't make that much sense. Due diligence, the same thing. I think it's the same routine which we have all over Europe. Whenever there is a listing, of course, there has to be actually some formality checks done, but it's not due diligence at all. It is just a couple of checks which are in the law, and you have to see whether the prospect or any kind of legal document actually which you get is actually checked against reality and the legal requirements.
Okay. Any other questions from the audience? There's one at the back. Matthew.
Brian Healy, the Irish Stock Exchange. Question for Michael, actually. Given the long-term technology partnership that you've had with Deutsche Börse, what are your views on life post the failure of the DB-NYX merger?
I think we would not have been very much affected by a merger maybe even more people in the long term trading on the same trading system, even UTP and etc. would have been put together. In the same way, I would think there is almost no effects of the breaking up of this merger now. And I understand even if they are now going to court on that issue, it's not really going to happen. They do it for some hygienic reasons. But anyhow, I don't think there's going to be much of an effect. The long-term relationship which we do have with Deutsche Börse is on the system side, and therefore also we do have the regions and the areas of growth within the Central and Eastern European area. This is our turf. They do know it, they do accept it, and this is what actually we are doing, and they are focusing on a total different level of size in their own acquisition and forward development strategies.
Anything else? The OTC space is actually a major competitor to exchanges. As we say, in the fixed income space, it's 85% plus is traded off market. In the equities, it's now 40%, of which between 10 and 20% has what's called zero anomalous, no market impact size. So, i.e. that trade could have been done on exchange without changing the price that it received. So why is it being traded off exchange is unclear, and the regulators need to sort that out. So the exchanges do need to try and work out how to get this volume back on market to protect investors. It is not good that it's in the OTC space. With that said, I'd like to thank the panel, and now we have a networking lunch. And we should be back at 2, where we've got an interesting topic on, again, carrying on this OTC theme. We've got a presentation from Calypso, where they're going to talk about the challenges of setting up an OTC CCP. So that should be very interesting. Thank you very much. Thanks to the panel.
Thank you.